Right now, as you watch this video, someone is getting an email that their rent is going up again. Someone else just had their mortgage application rejected. And somewhere, a family is being outbid on a home by an offer they never even saw coming. They're not being outworked. They're not being irresponsible. They're being priced out. Not by bad luck, but by a system that quietly turned housing from a basic human need into one of the most powerful financial assets on earth. Today we're going to break down why homes are becoming unaffordable, who is really benefiting from it, and why, for millions of people, the old dream of owning a home may never come back. Let's begin. To understand how we got here, you have to look at one simple ratio: the price of a home compared to the income of the people trying to buy it. In the 1970s and 1980s, in many countries, the average home cost around 3 to 4 times the average annual salary. That was not easy, but it was possible. You could work, save, and with some sacrifice, eventually buy. Fast forward to today. In cities like London, Toronto, Sydney, Dublin, Amsterdam, Vancouver, and many major U.S. metros, prices of typical homes can reach 8, 10, or even more than 12 times the average income. That is not a tough market. That is a locked door. Rents tell a similar story. In a growing list of cities, more than 1/3 of the average renter's income goes just to keeping a roof overhead. For lower-income tenants, that share can climb above 50%. So when people say young people just don't want to work hard and buy homes anymore, they're missing the point. The rules of the game changed. For previous generations, a home was something you could realistically plan for. For many people now, it's something you inherit or get lucky with. And if you are not already on the property ladder, the staircase keeps moving further away. So what exactly changed? It wasn't just supply and demand. It was something much bigger. For most of modern history, housing had one main purpose. You lived in it. Owning a home was an achievement, but it wasn't seen as a casino chip, or a retirement scheme, or a global trading instrument. That started to shift in the late 20th century. Governments encouraged home ownership through tax breaks and incentives. Banks discovered that mortgages were very profitable loans. Financial engineers created mortgage-backed securities and sold them around the world. Meanwhile, in many countries, interest rates kept falling, making it cheaper and cheaper to borrow money. Every step pushed the system in the same direction: higher demand, more borrowing, and steadily rising prices. Then came the 2008 financial crisis, triggered in large part by those very same mortgage products. You might think that would have scared people away from treating housing as a financial toy. Instead, something else happened. Central banks responded by slashing interest rates to near zero. They flooded markets with liquidity to stabilize the system. Suddenly, investors were desperate for returns anywhere they could find them. Bonds were paying almost nothing. Savings accounts paid even less. But housing still looked solid. So a new idea took hold. If you had enough capital, entire neighborhoods, entire blocks of homes could become a long-term investment product. And that is exactly what happened. For decades, the typical buyer was a family, a small landlord, or a local investor. But after 2008, more and more large players entered the game. Real estate investment trusts, private equity firms, pension funds, insurance companies, specialized rental corporations. They didn't come to buy 1 or 2 apartments. They came with spreadsheets, algorithms, and billions in capital. In some regions, these investors began buying thousands of properties at a time: foreclosed homes, distressed assets, and newly built developments. Sometimes they bought entire streets in bulk. To be clear, this is not a conspiracy theory. These purchases are documented in financial reports, public filings, and housing studies. The people doing it often talk about it openly. From their perspective, it makes perfect sense. Housing provides rental income. Over time, prices tend to rise. And unlike a volatile stock, a home is a physical asset. People always need somewhere to live. But there is a side effect. If a regular family wants to buy a starter home, and they are competing with a fund that can buy 10 homes at once, in cash, the family loses. If an investor is willing to pay slightly above asking price again and again to secure inventory, they nudge prices higher for everyone. Even when institutional investors own only a small share of total housing, their influence on certain neighborhoods can be huge because they are price setters, not price takers. And large companies are not the only players. We also saw wealthy individuals using homes as a way to park wealth, foreign capital flowing into safe cities, and local landlords expanding portfolios as credit stayed cheap. Suddenly, the housing market was no longer a local ecosystem. It was plugged into global finance. So what does it look like when housing becomes part of a global investment machine? It looks like this. Apartments that used to be long-term rentals become short-term vacation units, listed on platforms that can earn more in a weekend than a local tenant can pay in a week. Developers choose to build luxury towers instead of mid-range family housing because high-end units offer better profit margins, even if they stay partially empty. Local governments rely heavily on property taxes and development fees. That creates a quiet incentive. Rising values are good for budgets, even if they make life harder for residents. In some markets, new units are pre-sold to investors before they are even finished. They may sit empty or rotate between different tenants, but their main purpose is not shelter. It is capital storage. At the same time, rent increases become more systematized. Where an old landlord might know their tenants by name and negotiate informally, a corporate landlord might follow a formula, raise rents by a fixed percentage every year, as long as the tenant does not move out. None of this is illegal. Almost none of it is hidden. But it slowly transforms entire neighborhoods. The streets still look the same. The buildings still stand, yet the meaning of those buildings is different. They are no longer primarily about who lives there. They are about who owns them. Every system has winners and losers. In the financialized housing system, the winners are clear. Those who already own property, those who inherited property, and those who have enough capital to treat housing as an investment. When home prices rise, their net worth goes up on paper. They can refinance, leverage, or sell for a profit. But if you are on the outside looking in, the story is very different. Higher prices mean higher down payments. Higher down payments mean more years of saving. More years of saving mean more time paying rent instead of building equity. Meanwhile, rents themselves are rising. It becomes a treadmill. You run faster, but you stay in the same place. For many people, housing costs are the single biggest line in their monthly budget. When that line grows, everything else shrinks. Less money for savings. Less money for education, health, or starting a business. Less room for error if something goes wrong. This is how housing stops being just an economic issue and becomes a social one. It creates a divide between those who have a stake in the system and those who are permanently renting space in someone else's balance sheet. Over time, that divide becomes generational. Parents who bought when prices were lower can pass an asset down. Children who start from zero face the most expensive entry point in history. The result is a quiet shift. The middle class stops being defined by income alone and starts being defined by ownership. At this point, you might be thinking, okay, but can't governments just fix this? Sometimes they try. Some cities introduce rent controls. Some countries tax vacant properties. Others tighten lending rules or support first-time buyers. These policies can help in specific cases. They can slow down the worst excesses. But they rarely solve the core problem. Why? Because too many parts of the system are now tied to high home prices. Banks hold trillions in mortgage debt. Pension funds and insurers hold real estate-linked assets. Local governments depend on property taxes. Homeowners feel richer when values go up and unhappy when they go down. Politicians understand this. They talk about affordability, but almost none of them want to see a large, sustained drop in prices. That would be politically toxic. So the system tries to do something incredibly difficult. Keep prices elevated, while somehow making homes more affordable. In practice, that often means tinkering at the edges, while the structural forces stay the same. There is another uncomfortable reality. Building more homes is essential in many places, but new supply does not automatically mean lower prices, especially if the new units are designed and marketed first for investors, not residents. So where does this lead? Experts disagree. Some expect gradual corrections, periods where prices stagnate or fall slightly, giving incomes a chance to catch up. Others expect long-term stagnation. Prices stay high in nominal terms, but inflation slowly erodes their real value. And some warn about localized bubbles, markets where prices became detached from any reasonable relationship to local wages, and where sharp declines are possible. No one can say with certainty which scenario will dominate, but there are a few things we do know. We know that housing costs are already reshaping life decisions. When people move out, whether they have children, which jobs they accept, and which cities they can realistically live in. We know that younger generations are starting adulthood with higher rents, higher debts, and less housing security than their parents. And we know that the longer this continues, the deeper the divide becomes between those who own assets and those who do not. In the end, the housing crisis is not just about charts or interest rates. It is about something much simpler. Who gets to feel stable? Who gets to plan 10 or 20 years ahead? Who gets to say, "This place is mine, and I'm not being priced out of it"? For decades, we told people, work hard, save money, buy a home, and you'll be secure. But in a system where homes are primarily treated as financial assets, that promise breaks. So the real question is not just, why are homes so expensive? The real question is, if a home is supposed to be the foundation of a stable life, what happens to a society where millions of people never get to stand on it?